Hey everyone, and welcome to the channel. I decided to start sharing my analysis because I wanted to create the one thing I desperately needed when I first started trading. We've all been there. You jump into a trade, the market immediately turns against you, and that feeling of panic starts to set in. You're stuck. You don't have the experience yet to analyze what's happening, but you can't find any specific actionable analysis online to guide you out of it. That's why I'm here. This channel is built to provide that clarity. It's for the newcomer who feels lost in a bad trade, and it's for the seasoned trader who's looking for a professional perspective. All right, yesterday I conducted a deep analysis on Ethereum based on the smart money concept. The composite operator had finalized their distribution campaign at the highs, and the path of least resistance was to the downside. Let's do a quick review of the key data points. We identified the massive absorption of buy-side liquidity around the 4,700 level, where institutions were skillfully offloading their positions into retail euphoria. But the primary confirmation was the divergence in open interest, which began to climb as the price fell. This was our high confidence signal that new capital was entering the market to initiate short positions, not just longs taking profit. The result, the forecast played out with textbook precision. We witnessed the exact markdown in price that we anticipated. The bearish scenario was fully validated as the price was driven down to engineer liquidity below the recent lows. What's next? So yesterday's target has been met, sell side liquidity has been taken, and this is precisely where the market gets interesting. The average retail trader will now see this as a bottoming process and a buying opportunity. But this is exactly the assumption that fuels the next sophisticated maneuver. Was that the end of the markdown or merely the calm before the next storm? We are now at a critical inflection point, and smart money has two primary plays available. One of them is a particularly deceptive setup. Scenario A, the bearish continuation. This is the straightforward path. The operators continue to apply pressure, driving price discovery to the downside without a significant retracement, targeting the next major pool of sell-side liquidity. Scenario B, the smart money trap. This, in my professional opinion, is the higher probability play. The composite operator will engineer a corrective rally, a retracement back into a premium zone, like the fair value gap around $4,640 to $4,660. The objective, to induce longs from retail traders who believe the bottom is in and to liquidate early shorts. This manufactures fresh buy-side liquidity, which they can then use to fuel the next more aggressive leg down after adding to their short inventory at a more favorable price.